Hello guys and welcome back to the Italian trader Mark Prime channel on YouTube. Thank you for being here, I really appreciate that. If you haven't done so already, don't forget to subscribe, activate the notification bell and smash the like button. Anyway, today we are going to, in the simplest way, to talk about the Sharpe ratio. Sharpe ratio is something that has been, a lot of people have been talking about, for a long period of time. It was developed, by the Nobel laureate William F. Sharpe, and is used to help investor understand the return of an investment compared to its risk. So basically, in simple words, what you are looking at here is having a portfolio that not just is producing a lot of returns, but that is producing a lot of returns compared to the risk that the manager is taking. So let's say you are a trader. First of all, how is it calculated? Okay, this is the formula, but you don't really need the formula. There are a lot of tools online that you can use, but the formula is very simple. So basically, you are going to subtract the risk-free rate from the return of the portfolio, and you divide by the variance, by the standard deviation, of the portfolio. So basically, on the denominator you have the risk that you have taken, let's say the drawdown, okay, and then up here you have the total return minus the risk-free rate. The risk-free rate is basically what you would achieve if you were investing in treasury bonds, so the less risky possible alternative investment. Okay, so in simple words, if you have a high number, if the Sharpe ratio is high, basically you are a good trader. If the Sharpe ratio is low, you are not that good. If your Sharpe ratio is negative, then you should stop investing. Okay, so you should stop trading. So let's see here basically what we mean. So basically, let's say this is your equity curve, okay? Let's draw it with a pen. This is your chart, this is time, and this is profit, okay? So let's say you are doing something like this, and then you drop, and then you go up, and then you drop, and then you go up like this, and then you drop like this, and you go up. Okay, so you have different levels. So this is your dollar amount, okay, of what you get in. So if this area is isolate, you may have here like one number minus this number, so in percentage could be like 7%. Okay, so basically what you here that you, in this period of time, you lost 7% of your of your capital, or let's say you lost 7% of this equity curve. Okay, this is the simplest way. It's a little bit more complex than this, but you don't really need to do it in the deepest level, because we have the calculator here. Okay, it's easier to do that. So, and let's say that this total return is something around, I don't know, like 14%. Now you go to your calculator and you plot here 14%, the risk-free, let's say 0.2 yearly from the treasury bonds, and then you have the portfolio deviation, which is 7%, your drawdown. You calculate the Sharpe ratio, and the Sharpe ratio is going to say you 1.97, which is great, which is very good, which is literally very, very good. Okay, so let's imagine that you made like just 7 instead, and you calculate the Sharpe ratio here, it's 0.97. Okay, so you see here that basically the trader that with the same risk made 17%, let's say, which is 2.40. It's better than a trader that is doing 3% return, because 3% return is 0.40. Okay, So this is the calculator you can use. So for example, you have two traders or two strategies that you have or whatever. So you plot here the risk-free asset, let's say 5%, or this can be also the Standard & Poor index if you are a trader, for example, because you could invest in an investment fund, right? And like in an index fund, and have that kind of risk-free trade, let's say, even though it's not risk-free at all. Anyway, if you plot here like 0.3 and you have two traders that you know, one is doing 20% return and is risking 60% of his capital, okay, which is massive, you got a Sharpe ratio of 0.33. Then on the other hand, you have someone that produced 4% return and is just, you know, risking 1%. Now you have this massive Sharpe ratio. So you should prefer this guy, the 4% guy. Alright? So guys, I hope you enjoyed this video. It is very important to know the Sharpe ratio, you know, theory was this. And that's it. So have a great day. I'll see you in the next one. Don't forget to subscribe and like the video, and I'll see you in the next one. Bye.